Welcome to the Daily Brief, where I'll go over the action in the market for Wednesday, March 15th, and then we'll see how things look for Thursday, March 16th. We had another down day, but we ended up closing well off of the lows, so some bargain hunters came in, support held that I'll show you on the charts, and there's a few positive areas to look at that I'll go through in the video, but still things are decidedly negative. During the night, the futures were actually down about 2%. By the time we opened Wednesday morning, we still opened down, but well off of the lows of the day, and a lot of this is being attributed to Credit Suisse. They were down 20% during the night, and that really brought the U.S. futures down as well. So let's go back and talk about what happened. Right at the open, we did have a gap lower open below S1 at 38.84. Prices went down quickly then to S2 at 38.47. As the day went on, prices bounced around at the S2 level before rebounding. We got all the way back up to S1, and then we closed a bit above S1. We were down 0.73% on above average volume. We have seen a real pickup in volume as of late. The technicals are still negative overall. There's a few positive areas to look at. We still have a potential positive backdrop that kind of comes and goes, but it's still there once we work our way through some of this mess because of inflation and interest rates. But the real focus right now is this banking problem. Is that going to be a contagion? First, we heard about one bank, then another bank. Now we're hearing about a European bank. What's going to come next is kind of the thinking that we need to adapt. Or is this just going to get dealt with and then fade back into the background? Here's the intraday chart showing how we gapped lower down below S1. We came all the way down to S2, bounced off of this a couple of times, and then tried to rebound slightly. We came right back up to the S1 level and just danced above and below that, closing a little bit above S1. And we're still well below the 200-day simple moving average that you can see plotted above. What are some comments that we can make? The NASDAQ and the NASDAQ 100, they closed positive. They've been silently gaining a little bit of strength here. That's one positive aspect we want to see. Can that continue and eventually come over into the rest of the market? Then what happened is Credit Suisse's largest shareholder, the Saudi National Bank, said that it can no longer provide further financial help because of regulatory constraints. This produced a lot of worries about banks that are becoming more risk averse. They're tightening their lending standards, as I showed you in that one chart that hasn't been updated for a while now, and then managing their own balance sheets in a more conservative way. Ultimately, this could feed through into their economic growth and lead to continued downward earnings per share revisions. And if the banking industry group is having trouble, which feeds over into the financial sector, that could feed over into the stock market. Stocks rebounded after the Swiss National Bank said that Credit Suisse meets the capital and liquidity requirements imposed on systematically important banks. If necessary, the SNB will provide Credit Suisse with liquidity, and this provided some relief to the market. On a short-term basis, we still have our longer-term stochastic that is extreme negative. On an intermediate-term basis, the Arun is still extreme, the PMO steady, CCI 14 and 20, as well as the BPI. The dollar was up and interest rates were down, so the fact that interest rates went down helped stocks a little bit. Now we have the 30 to the 5 not being inverted any longer. It's kind of dancing around day by day, but all of our other yield curves remain inverted. Sentiment is still extreme negative. We're getting a reading at 20 where we drop down from 25. Looking at the condition of our trend, we're negative overall. The red line's on top. It's getting stronger. We're above the moving average, but it's still below 20. Our bias is negative with the down day, and the last number of days, for the most part, have been down, so I'm keeping our momentum at negative. The economic reports that came out, we had the weekly MBA Mortgage Applications Index. It came in at up 6.5%. Last time it was up 7.4%. The Empire State Manufacturing came in at minus 24.6. They expected it to come in at minus 8, so that was a lot weaker than expected. Last time we had this, it was down 5.8. Retail sales, this was weaker than expected. It came in down 0.4%. They expected it to be up 0.2%. Last time it was up 3.2%. When you take out automobiles, it was down 0.1% as expected. Last time it was up 2.4%. The PPI came in at down 0.1%. They expected it to be up 0.3% as it was last time. When you just look at the core PPI, it came in unchanged where they expected it to be up 0.4%. Last time it was up 0.1%. Business inventories came down 0.1%. They expected it to be unchanged. Last time it was up 0.3%. So we're seeing some weakness in these reports right now. The NAHB Housing Market Index came in at 44. They expected it to be at 42, as it was last time, so it ticked up a little bit more than expected. Here's a headline. Moody's is back on the move again, where they cut the outlook on U.S. banking system. They went all the way to negative, and they said this is because of a rapidly deteriorating operating environment. Another headline from Fox Business says that Moody's then flagged 6 other banks, and I have them underlined. First Republic, Zions, Western Alliance, Comerica, UMB, and Intrust Financial. They have some concerns, and so they're going to look into their credit ratings. Looking at the Fed funds rate, just to update this is where it was on Friday, March 3rd, where you had 71.6% of market participants thinking that we will raise rates 25 basis points at the upcoming meeting. After Chair Powell spoke, that suddenly switched to 50. And currently, we're at 63.5% saying that it will still be at 25 basis points, with a few even suggesting that they may leave rates unchanged. The Ulcer Index is a little bit above the moving average, showing that fear ticked up slightly. Here's the VIX. It went back up, both on the line chart and on the bar chart, so fear is coming back into the market. And we saw a pickup in the VIX of the VIX, so volatility is increasing. The equity put-call ratio turned up slightly, but what we're really watching is the 5-period simple moving average. It's continuing to go up, and it's getting above this 0.8 level, which sometimes can mark a bottom in the market. Because you have positions that are heavily hedged using put options. When this gets pretty extreme, a lot of times that will mark the end of a decline. Looking at another fear gauge shows that fear has been going up overall when you take a ratio of the shorter-term bonds with investment-grade bonds. When this is going up, that means that fear is increasing, and we're seeing a slight increase there. Looking at our trend, the red line's on top, so that's negative. We're turning back up with the ADX. We're above the moving average. The green line is declining, but we're still below 20 overall. So we're in a trendless environment, but we default to negative. The daily chart looks a little bit different than the chart I'll show right after this, where this appears that we're coming right back up to the underside of this trend line. But if you look at the next chart, we still have a little ways to go before we hit the underside. Now, I draw these lines myself, so they're not necessarily accurate. They're not drawn by a computer. I just eyeball this, so we kind of have to have a little bit of leeway with what we're seeing here. On the bottom, you can see where volume is still above average. The Arun is still chopping sideways, but giving us an extreme negative reading. Looking at value versus growth, large cap value, it was down less, but if you look at the mid caps and the small caps, growth underperformed value. Here's another look at the high beta stocks to the S&P 500 equal weight ratio. When this is going down, that means folks are assuming more of a risk-off type of stance, where they're getting out of stocks and getting into bonds, which are considered safer. The stochastics show in the short term we're still negative overall, even though we're bouncing out of an extreme negative reading. We're coming out of an extreme negative reading in the intermediate term, and now we're starting to enter into that extreme negative reading in the long-term stochastic. Our moving average tree shows that we're still below all of the plotted moving averages. Parabolic SAR continues to be negative overall with the dots on top. The Chaikin oscillator turned up and is coming back up to this dash line. That could be another positive sign that is developing. The PMO study, we're not extreme negative with the PMOs that are rising, but we are with the number of buy signals, and we continue to decline with the percent of PMOs that are above zero. The BPI continues to be extreme negative and continues to fall. Now, this could go a lot further, as you see has happened at previous times, but we are at an extreme negative reading. The NYSE bullish percent index continues to decline and is still above 30 overall, but this has more room to fall if prices continue to decline. The Chaikin money flow, this is another positive sign. It's actually turning back up slightly. It's still negative, but it's showing some improvement. The CCI 14 and the CCI 20 continue to be extreme negative. The balance of power showing a little improvement here. We're still negative. We're below the dashed line, but it's starting to move back up. The TTM squeeze also showing just a little bit of improvement, where the dark red bars are now turning to a pale red, and the bars are going up just slightly. With the go, no-go system, we are still negative with deep purple bars. We're still staying above this anchored moving average going back to the COVID low. That's the red line. So this shows that this support level is currently holding. Short-term fib levels, we still have this double fib level at about the 38.07 to 38.08 level. That support is still holding. We have some overhead resistance at the 39.06 level. Longer-term fib chart, this support level continues to hold at the 38.26 level if we continue to fall. And we have quite a ways to go if we hit more upward resistance at the 40.20 level. The weekly chart also shows that support continues to hold down at this 38.09 level. The Elder Impulse system for the S&P is still neutral. The McClellan oscillator is not necessarily extreme negative, even though it did decline, but is still negative overall. And the broader term McClellan oscillator is starting to go extreme negative. Summation index based on price and volume are negative and declining. The 5-period simple moving average of the high-low index still shows that we are declining, and we're also declining with the 10-period moving average. The advanced decline line ticked down slightly based on price and volume, and we're below the moving average. The advanced decline ratio, working off of that extreme negative reading with the 19-day exponential moving average, but we're still declining. The red line and the blue line continue to go down. This is another positive sign. The accumulation distribution is actually turning back up and crossed back above the moving average. Volume continues to advance. The financial sector just continues to get hammered, especially on the ratio between the financials and the S&P 500. The bank ETF was down another 2%. The regional bank ETF was down over 3%. And another regional banking ETF was down 1.63%. And then looking at the regional banking ETF and then comparing it to a ratio of the financial sector, ticked up just slightly, but it's just has this falling off a cliff look. The S&P 500 is still outperforming the S&P 500 equal weight. So that just shows that the big stocks, the growth stocks, the ones that really help the market to go higher or lower, are really performing a lot better than the rest of the market. The Dow was able to maintain support above this S2 level, but it's still below the 50 and 200-day moving averages. The diamonds are neutral. The NASDAQ holding up a little bit better. We're getting really close to a golden cross here. We're still above this S1 level. And the NASDAQ 100 above both of the moving averages, just giving us a golden cross now, but we hit resistance at this pivot level. The Qs are still positive. The small caps really getting hit hard again and showing some recent weakness after giving us a golden cross not too long ago. Here's another look at the small caps, showing how the RSI is getting extreme negative, where the MACD on the bottom is declining below zero, and that is negative. The small caps are negative in the Elder Impulse with a red bar. The small cap ratio is really breaking down when you compare it to the S&P 500. The mid caps also running into a lot of recent problems, and they're negative with the Elder Impulse system. The home builders, not quite sure what to make of this. We have the S&P going down, the home builders are going down. The ratio is now starting to decline, so this relationship is getting a little bit closer. I was kind of watching this chart to see if we were going to go down below this dashed line, which could potentially show a positive divergence, meaning the home builders are holding up better than the S&P. But with this going back up, that could be in jeopardy right now. Also, looking at the stock-to-bond correlation, shows that stocks and bonds are having a real tendency to go in opposite directions. Bonds right now are going up as stocks are going down. The Kopik curve, not getting to a cross yet, but we're getting close right now, so I wanted to show you this chart. If we see a cross above this red line, that will be a buy signal. Oil also really dropping now, down to 67.61. Copper also had a pretty weak day, down 4%, still in an overall uptrend. But we look at this as a barometer of the economy. When this is going up, that means the economic outlook is more positive. When we see this starting to come down, that can mean that the economic outlook is more negative. Here's the 10-year bond yield just bouncing all over the place. These are huge moves for these instruments. And here's the price of bonds showing that they're in an overall uptrend and just really breaking out to the upside. Another fear gauge that sometimes is useful to us. This is starting to spike back up a little bit, showing that fear is coming into the market. And then here's a look at Treasury yields, a daily chart, where they had been going up pretty strong. Now they're just starting to really go down quickly. Our long-term analysis, we're starting to drop below the MACD. Now please be reminded, this is a weekly chart. We have 2 days left in this trading week. If we have a real strong Thursday or Friday, we could turn this indicator back up. This is just the weekly chart as it stands at the close of Wednesday. if this continues to drop below, that would really support the idea that this breakout above the trend line was indeed a fake out. An update of our possible positive scenarios. This is a more positive thing in the background. The Qs still are outperforming the S&P. Not really doing as good with the discretionary, but the large cap growth is really performing large cap value. Then our growth to value ratios going up across the board. So this is more that positive backdrop that we may build from when the market finally gets done going down. This is another thing that's causing a little concern. This is on the negative side. The 50-period exponential moving average of the new highs minus the new lows. This red line is really coming down and in danger of dropping below zero. And here's the indicator itself. It's below zero and showing a lot of negativity currently. The 2-year treasury yield, after spiking up, is now coming back down. That could give some support to stocks, which is another positive backdrop. And the staples, this is actually breaking down just a little bit. We're working off of this really high spike, but we're seeing the spike starting to come back up. And this spike that we're working off of, it gave a little support to the stock market, but we want to see a real monster move from this that we're just not seeing right now. So what's our outlook for Thursday? The technicals are negative. There are some short and intermediate term oversold signals. We have weekly jobless claims coming out on Thursday, housing starts as well as building permits, the Philadelphia Fed survey, import and export prices, and then the whole list of geopolitical events with the banking issue being at the forefront right now, followed closely by the inflation and interest rate scenario. Looking at the Stock Traders Almanac statistics, we're up 52.4% of the time with the Dow, as well as the S&P 500 is up 57.1%, so that's neutral to positive, where the NASDAQ is more positive, being up 66.7% of the time. And then all of the other things that are adding to our potential positive backdrop. We're on trading day number 12 now. The dashed green line shows that we're up slightly on the day. And I'm giving the other charts a rest right now because we're really not adding anything new to that. So looking at our scenarios, you could go with the down scenario, but we're still flashing a lot of oversold indicators right now. Even though the ADX is strengthening and it's above its moving average, that is not confirmed yet by a cross above 20. So be careful with that if you decide to go in the short direction. Because our technicals are negative overall, however, we do have some short-term and intermediate-term oversold signals. We can't go with the up scenario right now because everything is pointing down. So we're still defaulting to the sideways trend with the ADX getting stronger, but it's below 20. It's negative with the red line on top. Our conclusion, the S&P is negative, but there are some short and intermediate term over signals. Short term negative oversold, intermediate term some oversold signals. Long term, we're still negative because we're below the 200-day simple moving average. Thank you. I hope you found this helpful. I hope you have a really good day, and I will talk to you in the next video.